Many seniors are very confused about the reverse mortgage program that started out in 1975 under President Ronald Reagan. The program was designed to help World War II veterans obtain access to the equity that they'd built up in their homes. On the first slide, you can see that the people's idea of reverse mortgages was for seniors that were already retired, most of them in nursing homes, and they were way down the financial trail. On our next slide, you can really see that the reverse mortgages in our seniors today have changed. Seniors today have grandkids, they're living longer than they've ever lived. They are absolutely in good health and are going to live to be in their late 80s or early 90s. So what's happened is that the economy's changed and the reverse mortgage program had to change with it. On the next slide, you could see that the benefits to the reverse mortgage today is having access to the home's equity and to pay off either an existing mortgage or some debt so that the senior is basically debt-free. They can also use the reverse mortgage to purchase a home and not have a monthly payment. Also, the reverse mortgage establishes a growth line of credit to where the people can become their own bank and borrow from their money when they need it without qualifying for a loan each time. Next slide shows that the reverse mortgage basics is that age determines the principal limits. What this means is that the older you are, the more of your home equity that you can obtain. Also, the older the better. So if you were 85, you could actually have a higher principal limit reverse mortgage than you could if you were 62. In the old days, the spouse had to be 62, and it's like that in Texas. Texas is the only state to where both the couples have to be 62 years old to do a reverse mortgage. In the other states, only one of the couple has to be 62. The spouse can actually be as young as 18. The heirs have a right to the property. If they want to buy the property, they have an option of paying the lesser of the appraised value of the property or the loan balance of whatever remains on the loan after the borrowers move out permanently. So the heirs have the right to sell the home, keep the profits if there are any, or they can actually give the home back to the lender and walk away from it. The responsibilities of the senior is to pay the insurance and taxes and the maintenance on the home. And without a house payment, that's really the only expenses that they have for a house for the rest of their lives as long as they live in the house. One spouse can actually go into a nursing home and the other spouse can remain on the house and the reverse mortgage is still in effect. On our next slide, we can see that reverse mortgages aren't just for low-income people or cheap houses. The FHA Guaranteed Loan Program on today's rates, you can actually do a reverse mortgage on a home up to $679,650. And there also is proprietary jumbo reverse mortgages through private lenders. In some states can go up to $6 million. So this new reverse mortgage program is not just for people needing a little money to make it work for them. The cost of money, once you use a reverse mortgage, your cost of money usually runs around 5%. And that includes the FHA MIP of 0.5%. So when you take money out of your reverse mortgage, it's going to cost you 5%. So the closing cost on these loans are about the same as an FHA loan on a regular purchase. They run about 6% of the appraised value on lower price homes and about 5% appraised value on the more expensive homes. 2% of that fee is the FHA funding fee, and 2% is the origination, and the other 2% covers title and attorney's fees to make it happen. To understand the reverse mortgage, you have to understand that there are actually two separate types of reverse mortgage loans. One is for refinancing, and one is for purchasing. So let's look at the reverse mortgage program first. You could actually, if you were 76 years old and selling your house in another city and relocating, or selling a house and downsizing, and let's say you cleared $150,000 cash. Well, you could actually find you a $150,000 downsized home and pay cash and not have a house payment. But with the reverse mortgage program and 76 years old for the youngest borrower, you can actually combine that $150,000 cash with a $150,000 reverse mortgage and spend the rest of your life in a $300,000 home instead of a $150,000 home. That way you got a lot of room for your kids and grandkids to visit or try to move back in with you, whichever works for you. So based on the youngest borrower's age, the percentages on buying a home are the older you are, the less you put down, and the younger you are, the more you put down. On this slide, we can see at age 62, you would put 59% down on a home and never have a house payment the rest of your life. At age 76, you would put 50% down. So if you were trying to buy a $300,000 home and you were 76 years old as the youngest borrower, then you would put half of that down. The closing costs are actually rolled into the mortgage, so all you bring is what is required for your age. At age 85, you only have to put 40% down and never have a house payment the rest of your life. Understanding the reverse mortgage refinance program, it starts with the slide where you could see at age 62, after the closing cost is deducted, there's a 35% yield. So if you had a $100,000 home at age 62, you would actually have access to $35,000. At age 76, you would have access to $44,000. And at age 85, you would have access to actually $54,000. So the closing costs on refinances are deducted from the yield. You don't bring those to closing. So all that you bring to closing is if your current mortgage is more than what the reverse mortgage can pay. That way you may, at your choice, bring money to closing and eliminate your mortgage payment for the rest of your life. The other program that's so popular with reverse mortgages and the seniors today is the line of credit program. It's almost exactly like a bank line of credit in that when you need it, it's there, and when you don't need it, it gets bigger. To explain that, the reverse mortgage line of credit actually allows you to become your own bank. You can actually borrow from it, and if you want to, pay it back and use that money again. If you don't use your line of credit, the unused portion can get bigger, 5 to 6% bigger a year. So if you had a $100,000 line of credit, reverse mortgage, then next year your line of credit reverse mortgage would be $105,000. The next time it would be $110,000. Next year $115,000. And there's no top limit. It grows every year that one of the borrowers lives in that home. The used portion, should you need some of that, becomes a loan and grows at 5% loan cost a year. So a $100,000 loan on a reverse mortgage will grow to $105,000 next year. But you can pay that reverse mortgage loan off or reduce it, and that money becomes usable again, and it also grows again at 5% a year. And each time that you reduce that balance on your home equity line of credit, it creates an interest deduction for your income tax. Do you have to wait till you're age 62 to start thinking about reverse mortgages? Actually not. Magic age for considering a reverse mortgage is 55 years old. Because if you're making the right decisions at age 55, you can save years and years of mortgage payments to have a home with no payments. So in our next slide, we're going to show you ages 55 to 60. There's actually a down payment schedule if you would like to buy a home and be able to convert to a reverse mortgage at age 62 and not have any more house payments the rest of your life as long as you or your spouse remains in that home. So what we want to do is make sure we're on a 15-year mortgage. We're figuring that our interest rate should be 4% or less, and we're figuring our house appreciation will go up about 3% a year, which lately it's been a lot more than that. So on our next slide, you see that at age 60, if you put 50% down on a home, in just 2 years, you'll reduce the principal on that home 11%, and with your house appreciation going up 6%, you'll have enough equity in that home to do a reverse mortgage and not have any more payments. So imagine, buy a house at age 60 with 50% down, and in 2 years, no more house payments for the rest of your life or your spouse's life, as long as one of you lives in the home. As another example, at age 55, if you put 20% down, in 7 years you're going to turn 62. But being on a 15-year mortgage in those 7 years, you're going to reduce the principal on that home 40%. Your house appreciation will go up a minimum of 21%, meaning that you'll have 81% equity in that home when you turn age 62. That means that not only will you not have a mortgage payment anymore, but you also will have extra money to put into a line of credit for your use in years to come. So if you have any more questions about reverse mortgages, or something comes to mind you'd like to ask about, just contact us at wha-us.org. That is our website, wha-us.org, or email us at wha.us@gulftel.com. That's wha.us@gulftel.com. And have a nice day.